Hello friends, a very warm welcome to my channel. In today's video, we are going to do the analysis of Clean Science and Technology. This is one of the niche specialty chemicals companies in India which is highly innovative and earns very high margins in its business. So they have clearly differentiated their products from the other companies and they enjoy such high margins because of that. It was one of the highly successful IPOs of the recent times, and post listing the stock gave a good rally, and thereafter it has been consolidating for a very long time. And a lot of time I've got requests to make video on this company. So if you're new to the channel, please do subscribe and hit the bell icon. And if you're not a part of our Telegram channel, do join today by searching my name on Telegram, as we post daily market analysis on our Telegram channel. So let's begin a crisp analysis of Clean Science and Technology. So this will be the flow of our presentation. We'll start by understanding the business model in brief. We'll look at the chart for the last couple of years because it's a recently listed company. We'll see the main financial parameters to judge the performance in the recent years. We'll discuss the reasons for the fall in the share price. We'll understand what is the outlook of the company going forward. We'll look at the valuations, historical and the present valuations. We'll understand the major risks of investing in this business, and by considering all these factors, we'll come to a conclusion whether it is the right time to hold or invest in this company. So Clean Science and Technology is a specialty chemicals company. They are into niche chemicals. It's a highly innovation driven company. They have an exclusive R&D team and 4 R&D labs to continuously innovate and develop new products. And because of this, they are global leaders, not just in India. They are global leaders in certain specialty chemicals and they enjoy very high margins in their business. When it comes to specific chemistries, they work on more than 10 chemistries which is into specialty chemicals, and they have more than 500 global customers and supply to more than 30 countries across the globe. 72% of the revenue of the company comes from exports, and that is why the business of the company is in a slight slowdown in the recent times. In terms of manufacturing facilities, if you see, there are 3 manufacturing facilities and the total capacity of manufacturing comes to about 44,000 MTPA, which is combined for all the plants put together. And their research team comprises of more than 90 plus scientists, and they have 4 R&D facilities located in India. When you look at their business broadly, you can divide their business into 3 sub-segments. The first segment is the performance chemicals, the second is pharma and agro intermediates, and the third one is FMCG chemicals. So we'll not get into much of technical details, but their main products in these 3 categories are MEHQ, which is one of their major products, and BHA and HALS. In pharma and agro intermediates, their main products are guaiacol and DCC. Similarly, they also supply to the FMCG companies. If you look at the revenue mix in Q1 FY24, just for a sake of understanding, the performance chemicals comprise almost 67% of the business of the company. The pharma and agro intermediate comprise about 19%, and 13% came from the FMCG chemicals. So this is the broad contribution in terms of revenue of all the 3 segments in this company. In terms of geography, China contributed 21%. So being an Indian company, they are supplying to China. This shows the strength of the business in the company. Indian market comprise about 37%, Europe about 13%, Americas, which is the North and South America, comprise about 19%, and the rest of the world about 10%. When you look at the chart, post listing, the stock did really well, and at that time the chemical sector was also in a tailwind, and it touched nearly 2,700 kind of levels post listing, and from then after it is into a correction mode, and now it is sideways, making a base of somewhere around 1250 zone. It made earlier 2 lows at somewhere around 14-1500 levels, and now these levels of 14-1500 range are acting as resistance for the stock, and that is why it is sideways. So unless the valuations get normalized, unless these headwinds, global headwinds of the chemical sector don't subside, unless the revenue and the profits come back on track, this can continue in consolidation mode and then later show a recovery from the lower levels. In terms of revenue, in the last 5 years, it has shown very good growth. It has been growing at a CAGR of more than 25% every year in the last 5 years, from 393 crores in FY19 to almost 936 crores in FY23. In terms of EBITDA also, there is a constant increase from about 136 crores in FY19 to almost 400 crores, which is almost 3 times in FY23. In terms of EBITDA margin, the margin improved from FY19 35% to 51% in FY21, and now it is sustaining at somewhere around 43-44%. Now if you look at the margin, this is very high compared to the other specialty chemicals also. A lot of companies claim that they are specialty chemical companies, but they earn a margin of just 10-15%. So if you are really a specialty chemical company, if you are into R&D, developing niche products, if you are a global leader, then these are the type of margins you should enjoy that is when you will be called as a specialty chemical company. Now, what is the reason for the fall if the company is such a good company? The company was facing headwinds in the global markets. In the Indian market, it was doing well, but when it comes to the global market, there was a slight slowdown. People had piled up inventory in the chemicals which they were clearing, and slowly the demand is coming back. So because of this, there was a drop in revenue, although the margin was more or less maintained. And in terms of valuation, the stock was given very high valuation post listing, and these valuations are now getting normalized. What is the growth outlook, or how does the company intend to grow going forward? They are quite confident that the EBITDA margins will be maintained at these kind of levels above 40%. The greenfield capex which the company has planned is on track, and the new capacities are coming in. In India and abroad, they are expanding geographically, and their R&D team is continuously working on adding new products in their specialty chemicals division. If you look at the valuation, at one point of time, the stock was getting a valuation as high as more than 50 times the revenue, which is now normalized and bottomed out at somewhere around 15 times. When you compare this with other companies in the same sector, you will feel that this valuation of 15 times itself is very high, which is quite natural because this company enjoys such kind of a business advantage and such high margins compared to others. So these stocks generally trade at a premium valuation, and because the margins are high, even at these multiples, the PE ratio is not that high for these kind of companies. So one thing we should understand that there are two types of investments. One is a value investment and another is a growth investment. So these kind of companies are growth companies which grow faster, which enjoy certain competitive edge, and that is why they continuously trade at premium valuations, and as per their growth going forward, these valuations are maintained. What are the risks of investing in this company? If this global slowdown continues for a few more quarters, the stock may consolidate for a long time. If the company is unable to deliver the performance which they have promised, if they are unable to maintain the margins which they are intending to do, if their capex is delayed and their capacities are not expanded in time, such kind of underperformance may lead to a correction in the stock. In terms of valuations, this stock, as I said, is a growth company, so it enjoys premium valuations. But in case this competitive edge is at risk because of competition or due to any reason the margins drop, then this premium what the market is giving, the market will take it back and there could be a sharp correction in the stock. Now, after understanding the business model, the growth prospects, the risks, and all these things, what is our conclusion about this stock? If you are already an investor in the stock and if you are holding at these kind of levels, you can continue to hold because the downside looks very limited as the chart is looking bottomed out now. And if you are looking at a fresh entry in this stock, first you have to choose your investing style, and if you are a growth investor, only then you should invest in such companies. And on the charts, there are still no signs of a clear reversal, so you have to gradually accumulate this over a period of time, and as and when the demand recovers, only then you will see a recovery on the charts for this stock. Please do note that this is not a buy or sell recommendation. We are just discussing as a case study purpose. I am putting the facts in front of you and you are to decide and take your own decision based on your financial advisor's advice. So that's about Clean Science and Technology. I hope you like the video. If you like it, hit the like button and share with your friends. And if you want me to make the videos on your favorite stocks, don't forget to mention those names in the comment section. I will add them to my Telegram poll and you can vote on that. So don't forget to join my Telegram channel. Thank you for watching and have a wonderful day.